Welcome, Stephanie. I know we're going to be talking about a lot of different things today, but let's start off. What are some focal points for investors right now, where we are?
Good morning, and thank you. It's such an honor to be here and to be talking to your clients and to you all as well. I thought I would start with what are some of the debates and discussion points that are going on with my colleagues, myself, and others pretty broadly. And we can dig down deeper if you like, but I think that the big 3 points are: where are we in the economic cycle? Where are we in growth in the economy? Are we at peak growth? Meaning all the stimulus and monetary policies and fiscal policies that have been put into place, it's starting to kind of roll over a little bit. And is that going to lead to a rollover in growth or not? That's the first point. The second point is inflation transitory? And I'm so sorry to use that word because I'm so tired of hearing that word, but truly, what does it mean? Is inflation really, is it temporary or is it more permanent? And the third point is, what the heck is happening with the bond market? Why are rates so low in the face of such strong growth? So those are the 3 kind of big picture points. And I feel like I do talk about it almost daily on TV, but also it's a debate that we have in our investment solutions group. And I'm sure you all have the same conversations and debates and discussions as well, because these are really the hot topics. And this is what is driving, again, the equity market, but also the bond market. So I would simply say, I do think we are at peak growth. I think all of this stimulus that was put into place last year, which was, if you combine the fiscal and the monetary policies, if you combine them together, it was as much as 60% of US GDP. Just to put that into perspective, the last financial crisis that we had in 2008, if you added the combined fiscal and monetary policies together, it was 5% of US GDP.
Wow.
So we have had an enormous amount of liquidity. And guess what? It did its job, right? It got us out of this horrific recession. Even as short-lived as it was very, very painful for all of us. It got us out of that, and it got us to, oh, by the way, we're probably going to do about a 9% GDP growth rate this year, and maybe even higher than that this quarter. So it's done its job. It's not over. There's still a lot of liquidity in the system. Listening to on the monetary side of things, the Fed Chair Powell, he's staying very much on point in terms of keeping monetary policy very accommodative. We might get another package on the fiscal side and infrastructure. Maybe it's a little smaller than we thought, but it's still going to be more. So you still have lots of liquidity kind of sloshing around, if you will. So while we're at peak growth, in my opinion, I do not believe that the bond market is telling us we're going to go into a recession. We're going to totally go over the cliff in terms of growth. What I believe is, sure, if we do 9% growth this year in the economy, we might do 4% next year. That's still above trend. Trend is like 2. Right? So I believe very strongly that's something that we have to concentrate on. You're going to ask me, okay, where is this growth coming from? Well, the growth is coming pretty broad-based. The consumer, which we know is about 70 to 75% of the US economy, we keep a close eye on the consumer for that very reason, right? We're rooting for the consumer to do well. And I think they are doing well. There are ample jobs out there. In fact, there are 9.2 million jobs openings out there. Quit rates are at record highs, which means, what's a quit rate? If somebody quits, that means that they believe that they can get a job fairly quickly, right? Or they might even have a job, or they might even have 2 offers at this point. So with 9.2 million job openings out there, there's a lot to choose from. It's trying to get these people to the offices and to restaurants and to stores to get them to work. And while I think a lot of it has been held back because of the fiscal stimulus, right? These checks that they've been getting in the mail. That may run off in September. I don't think it's going to be 100% runoff, by the way. I still think there's going to be quite a bit of accommodation there. So we'll have to see once they don't get those checks, do they actually start to return to the marketplace? We'll see. But there are jobs out there, and we are seeing an improvement in initial claims and that sort of thing. Wages are going higher. I'm sure we all have anecdotal data points in terms of wages going higher, and listening to kind of restaurateurs and listening to the travel people and listening to all kinds of retail. They can't get the people. To get the people in the door, they've got to actually increase wages. While that's an amazing thing for consumers, we're rooting for that, maybe it's a little bit more of an uncertainty for corporations, because how do they handle those higher costs, right? So we'll have to see in this how it all plays out, right? Do these companies raise prices? We already know, not a recommendation, but we already know McDonald's and Chipotle and Amazon, we already know those companies already announced increases, and there is a ton of companies out there that have announced wage increases. So we've got jobs improving, we've got wages on the rise, we've got home prices up on an average 18%, and we have a savings rate, while not as high as it had been at 27% at the peak, it's still at 11% right now. The historical average on savings for the consumer is 5%. So you've got about $1 trillion, maybe even $2 trillion in pent up demand from the consumer. And I don't know about you guys, but I am dying to get out and about, right? I'm dying to travel when it's safe to do so. But I think that is going to be certainly a theme, this reopen kind of concept, because we haven't been able to really come and go like we wanted to, and I think we will be able to do that though going forward. So I think all of this wraps up into a very healthy consumer. Manufacturing, while it's only 12% of the US economy, there's a multiplier effect. For every one job created in manufacturing, 7.7 jobs are created around it. So one of the reasons why we are so obsessed about this infrastructure package, well, A, we need it desperately, and B, if you want to help the unemployment rate and you want to help the job market, this is one way to do it pretty darn quickly. And so we are rooting for an infrastructure package, whatever the size is. But I look at manufacturing as a whole, and I'm not going to get too wonky on some of the data points that I look at, because it's ISMs and PMIs and it's all these kind of initials that are confusing. The one data point I look at is new orders. New orders are a leading economic indicator for earnings. And new orders are a leading economic indicator for CapEx spend. And we're rooting for CapEx spend, right? And so when you look at new orders, it's a diffusion index. So anything above 50 is expansion. So we have been in the new orders camp, we have seen 60 for the last 12 months, right? So if you think about that, there is such an enormous amount of pent-up demand. Inventories that are a 5-year low within the manufacturing and industrial parts of the economy. So you can only imagine, they've certainly been hit by the supply chain, and I can't wait till we talk about that and that topic, but they have been hit dramatically from the supply chain issues. But at the same time, demand is actually also on the rise. So we are kind of monitoring all of these things. It is not a perfect world, but that leads me to my second point of inflation. Is it transitory or not? And let's just step back for half of a minute. And I said this on CNBC this morning, when hopefully all of you were asleep at 5 a.m. But I did say that, why is inflation happening? Yeah, sure, it's because of these supply chains, right? And these issues that we have seen, because we literally shut the economy down. And you can't all of a sudden turn it back up really quickly. So it just takes a lot of time. But if you listen to companies out there, and there are quite a few semiconductor companies that have said most recently, supply chains are going to take a long time to resolve themselves. A year, 2 years in certain industries. So brings me to transitory. What is the definition of transitory? Is transitory 3 months, 6 months, a year? A year is not so transitory to me anyway. Sure, you can say, inflation is here and it'll eventually decline. But if it's a year out, we all, as consumers and business people, have to deal with that. And so you are going to have behavioral changes. So I believe if you look at inflation, there are certainly pockets right now that are seeing transitory in that's commodities, right? You've already seen a rollover in copper and lumber and that sort of thing. Where we are not, I do not believe is transitory is, again, this wage increase that we've seen, because that's stickier, right? You're not going to raise wages and all of a sudden take them back. And I had this argument with, or a debate with Steve Leisman on CNBC 2 days ago. And he said, well, you raise wages once and then it's no longer inflationary. Well, you still have higher wages, though. You still have a higher level and a base from where you were. So to me, I think it is actually stickier and it is going to contribute to inflation. The other thing that's interesting is that shelter costs are starting to rise. And that's because moratoriums have started to become lifted, right? So now you have wages going up and you have shelter going up, and shelter is not going to go up and then come down unless you do have a recession. And that's not my base case. So we can debate that if you like. We can have more of a detailed conversation about it. But those two pieces of inflation to me are real. And then I would simply say, this is a little wonky, but there's within one of these manufacturing surveys that I look at, they have this one component that's called prices paid. So it's the prices that manufacturers are paying. Okay. So for all kinds of things, and the prices paid index came in at 92.1. That you don't need to know that number, but it's the highest number since 1979. I was barely born. Kidding. I was very much born by then. But my point is that is a very, very large number, and that's a big hurdle to get over. So the debate on inflation, we can talk about it all day long, but I believe there are parts that are real and parts that are temporary. But it is what it is, and it's because growth and stimulus is in the system. And then the last point is that on interest rates, I got to tell you, I scratch my head. I really do. I can give you all kinds of excuses. I would love to hear what you all think about it. But is it the Fed that the Fed is in the system and it's flooding the system with a lot of bond buying, 120 billion a month? Is that it? Is it the BOJ just announced a new stimulus package, and so they're buying our bonds so that they can fund that? Is it the ECB who just said last week that they were going to follow the Fed and say, we're going to let inflation run as hot as can be, and then we'll decide when we need to actually put the brakes on? Is it the Delta variant? Is it saying, you know what, it's a little more serious than we think, and I know it's serious, but for now it seems contained to some degree? Or is it simply that everybody was on the wrong side? In mid-May, everyone said, oh, bond yields can only go higher. And so there were a record amount of shorts in the system that were shorting bonds. So now they're covering. I don't know. You can pick any of these. I don't know if any of them matter, quite frankly. It is what it is. But let's just step back half a sec and say, if you have better than expected trendline growth, and you have a little bit of inflation, not runaway inflation, but a little bit of inflation, which is never a bad thing because it implies that growth is actually better. If you have those two things, and at the same time you have record low interest rates, if you step back, isn't that really good for equities and risk on assets kind of thing, right? It is good because it means that the interest rate environment is good for consumer and corporations. It means companies can actually grow earnings above trend. The question is, can they get the pricing power? And that is what we're all kind of debating and discussing and that sort of thing. So while I am always looking for kind of glass half full opportunities, because I am a long only portfolio manager after all. If I was a hedge fund and I could short, well, maybe I would be a little bit different. But I do think that all of this is really very positive in the long run, and we have a runway to go in terms of the economy, in terms of earnings, in terms of the consumer enjoying all the help that they've gotten, as well as the plentiful job market. So I can find all kinds of things to talk about in this economy. What's interesting about the market, and just kind of drilling back down in kind of the equity market in the S&P 500, is this year has been all about rotation. It's been, for the first 5 and a half months of the year, value stocks worked. And that's because everybody was excited about all this stimulus and the growth, and you want to own value stocks when growth is above average. You want to own growth stocks when you think you don't have real growth, right? Because that's where you want to find the growth, and it's in the growth stocks. And so what I have said all year long is that you want to have a barbell. You want to have some economically sensitive companies, right? You want to own some energy and industrials and materials and financials, as hard as that is, because they're not really glamorous kinds of groups, right? But you want to own some of them because if you believe, like I do, above trendline growth, they should see operating leverage as a result and better earnings. That's just what that means, right? Just better earnings. And if you look at secular technology and growth, you don't want to miss out on some of these amazing total addressable markets. Total addressable markets like AI, which is $1 trillion total addressable market by the end of the decade. Cloud, which we'll talk about in terms of the supply chain. That's easily $1 trillion total addressable market by the end of the decade. You all know retail e-commerce. Retail e-commerce was a $3 trillion total addressable market in 2019, headed to 7.9 trillion by 2026. Those are real trends. I could go on and on and on in terms of wearables and EV and all that kind of thing, but you get the point. You don't want to miss out on where there really is some substantial growth opportunities, particularly when you do get these rotations in the market. If you do have growth sell off, well, you know what? That's when you look for, okay, well, wait a second, why wouldn't I want to have exposure to these names? And by the way, the stock is now 20% cheaper. Same thing on the economically sensitive companies as well. So I think it's important to have a barbell. It's important to have the diversification. And that's really what the barbell means, is just having a diversified portfolio. But I scratch my head of all the things I just said to you. I scratch my head on the bond market, and I'm sure you guys have better answers than I do. So I'm going to turn it right back to you guys.
Well, yeah, thanks. That sets up an awful lot of topics to talk about, Stephanie. Thank you. And our solution to the bond market is, if you don't like the game, don't play the game as much. So we are definitely at one of our lower percentages in bonds in our firm, I think in our history, but and using a lot of bond substitutes. But back in the old days, and we're not talking that long ago, back in the old days, 20 years ago, inflation and interest rates were more joined together. And so if you had one, you kind of expected the other to follow along, which again is one of the big head scratchers today. And I think you pointed out some of the reasons that could be part of the issue that's going on. But one of the things that our clients often ask us is, and we have about a half a dozen frequently asked questions here. You addressed actually a couple of them already, but one of the questions that our clients often ask is, what can go wrong from here? Now you gave a picture of a lot of things going right, with a few little wild cards in there like Delta and some other things. But you know, what keeps you up at night?
And it's the right question to ask, and it's a great question to ask, because you always want to look at the other side. While I am glass half full, I do pay attention to glass half empty and what they're saying. And I would say the number one concern is that the Fed overstays the welcome, right? That they keep too much policy in place and that they get behind the inflation curve. If you guys saw or heard Janet Yellen yesterday afternoon, she was on CNBC, and she basically said, yeah, you know what, inflation is going to run hotter for a little while, but that's a short-term, medium-term thing. That's not going to be a long-term thing. If you listen to Chairman Powell, he says the same thing. Inflation is actually quite strong and stronger than we thought, but it, again, is this word of transitory, whatever that even means. So the concern that I have is that they are actually thinking this is going to be more short-lived than longer. That is the big debate. And I got to tell you, none of us have that answer. But I can tell you that with all this massive stimulus in place, it doesn't turn on a dime. It's a big ship to turn, right? So you have to be ahead of the curve and ahead of the trends. And I'm really surprised that the Fed and Chairman Powell is saying that, they're going to be patient, they're going to watch the data, and they're not going to change right now. So it's interesting. The Fed is comprised of many different people on their board, and there are some that are kind of dissenters, there are some that aren't, right? And so one of the Fed one of the Fed members said yesterday, Bullard, who is kind of a hawk anyway, but he said, you know what, we've made substantial progress on the labor market, and we should start to at least discuss tapering. Tapering meaning starting to take the foot off the gas and end 120 billion a month in terms of bond purchases. Well, he has said this the last couple of weeks, but it certainly is interesting because he's never used the word we've made substantial progress in the labor market. Well, by the way, we have. That's the reality, right? But you can listen to all of the various different Fed members. I find it interesting because they're all brilliant. But there's only one person that's going to make that decision, and that's Powell. And if he is sticking to his knitting, no matter what we're seeing here, I think he's making a real big bet. He could be right, and he could be brilliant, and he could be. This is the best, navigation of massive recession to massive growth on the planet Earth ever in history. Or he could be behind the curve, and being behind the curve means that inflation is going to run hotter, and they're going to have to tighten more and more and quicker. And then what does that do to the growth story that I just talked about, right? So that's your one, I think that's my one worry. So in the next couple of months, just pay attention to what he's saying, his tone, but it certainly sounds like he's sticking to his knitting. There are some rumblings, by the way, I'll just say this, and I do not know this to be the case at all, but I'll just throw it out there. There are some rumblings that he might be replaced. Larry Summers is actually a name that has actually been floating around. Have no idea if that's to be true, but it's just be mindful that if there is a change in the leadership at the Fed, that's a game changer. That's a game changer, because then we have no idea what the policy will be, what the visibility will be. And so that's another thing that I worry about. And then I guess finally, the last worry is the consumer in general. So because I said it's such an important part of the economy, that if they were to falter in some way, that would be very disturbing, because we really are rooting for them. But I just don't see that to be the case, just given all that they have right now and the savings rate and the checks that are still in. And as I mentioned, certainly seems like the checks, while they won't be the levels that they were or they have been or are, by September, they may get cut in half, but it's still something. It's still something. And so, because we do have it is sort of fragile, right? While we're saying that there's a boom going on, it's still, come on, there's still pockets in the economy that are not terrific. I mean, just ask any of the travel and leisure and restaurant companies, right? You guys, when you go out to dinner, I mean, they can't get enough people, right? And so therefore, again, what does that mean? Does that mean they eventually come back? Do they not come back? So I think there's plenty to worry about. And believe you me, Dennis, I do not sleep very well at night, just in general, but there's a lot going on right now, and especially with the markets at record highs.
Well, and yeah, thanks for that. And the inflation piece, I think our clients think of that less as a risk to their investments and more of a risk to their own personal pocketbook, which, by the way, a few months ago, we had reported out to our clients that in analyzing a lot of the budgets in their financial roadmaps, that only 30 to 40% of most of our clients' budgets are even subject to higher inflation.
Oh, wow.
And there was a fairly substantial percentage subject to disinflation or even deflation. And so, again, I think this is one of those where there's a lot of worries that, oh, is this going to be the 1970s again and hyperinflation? And does that concern you at all?
No, I don't think we're going to see hyperinflation. And I'll just tell you why. It's all about technology. We have so much more technology and productivity in the system that is the force against the inflation piece. That being said, we will all feel any little bit of inflation because we haven't had it. in forever. I mean, I have colleagues that I work with who never have seen inflation. I've practically never seen inflation, right? So I think though that technology has changed so much to our and it's so important to our economy, right? Think about just as it measures to the S&P 500. If you add up technology, that sector, and the communications services sector, which is kind of like the FANGs of the world and that sort of thing, you add those two together, you're almost at 38%, 38% of the S&P 500. So that's just to tell you that it's such a big part, not only of the market, but of the economy. And we all can't live without it. And now after COVID, we really can't live without it. And I just don't think that that is going to change because we go back to the office. I just don't think we're ever going to be back to where we were, because we can do so much from wherever we are at. You just have to have this little laptop and a nice little MiFi card, or you have to have some internet and some Wi-Fi, and you can get a lot accomplished. And this is why I say you just want to have exposure to that part of the market and that part of the economy, because it is so powerful and it's so fun and so important. And how about every day? This is one little example. How about every single day we hear about cybersecurity and all these cyber attacks? That's just one little pocket. And they say, this is Gartner, not myself, Gartner Group, which is a wonderful industry publication, and they track all kinds of trends in technology. And that's why they say it's going to be an $800 billion cybersecurity. It's going to be an $800 billion total addressable market by 2025. That's only a few years away. So these are all kinds of things that I think are very, very important. And while I know that there are some high flyers within tech and within the themes of stay at home or go back to work or whatever, you just want to make sure that you're focused on kind of the bigger picture. And the bigger picture is these companies are helping our lives and we are more productive in general. And that's going to be the force against some of this other stuff in terms of inflation. But guess what? Productivity and technology is not going to help higher wage costs and higher shelter costs, right? It'll help on other parts of inflation. So there is a push-pull for sure.
Well, and one of the interesting sub pieces of that analysis we did is that a third to a half of the inflation that we were seeing in clients' budgets were what we would call lifestyle inflation. And coming out of the pandemic, people want to kick up their heels a bit. They want, maybe instead of staying at a 3-star hotel, they'll stay at a 4-star, or they'll, pamper themselves a little bit more. Now we're hearing that a lot on remodeling too, where we have that conversation, it seems like daily with clients. And well, I want to make the bathroom just a little better. So that's actually a form of inflation, but not the form we've been talking about.
Sure, absolutely. If I'm going to be working from home twice a week and going back 3 times a week, I do want a nicer kitchen and a bathroom, right? Of course, and you want a nice outside. And then the housing part is, my goodness, talk about a multiplier effect, right? You buy a home, okay, you need to put stuff in the home. And then as much as this pains me, you have to make your outside home, part of the home, looking better and well kept and that sort of thing. But then it's also auto. There's a very high correlation between auto and light truck sales to housing. And of course, we know why housing is booming. There's no supply, right? So there's only about 2 months worth of supply. Back in April of 2 Aprils ago, that supply got up to 6.5 months. So you've gone from 6.5 months to 2 months worth of supply in homes. And the kind of the equilibrium, the balance is about 3.5 months. So just to tell you that we don't have a lot of homes, right? And people are flocking to cities still, believe it or not, to live in the burbs and to get out of the city. And so you have that. And then I talked to a bunch of housing companies, and they have said it's really a very big shift in millennials. Finally, the millennials are leaving the home, right? Because maybe they're tired of living with their parents, especially after COVID. I don't even know, but they are finally moving. And that is why some companies, especially the companies that have built starter homes, are just, the pipelines are huge. They can't keep up with demand, which what happens then? You can't keep up with demand, prices go higher, And you have to watch affordability. And that is exactly why in the last couple of months, we've started to see a deceleration just in the month over month kind of trends, right? And of course, the TV just wants to make it all negative. It's not negative. There's just not enough out there, and you have so much demand, but you do have to worry and watch a little bit about affordability, because you just don't want these people to get priced out of the market. But it is a huge multiplier effect, and we're seeing it. And to your point, Dennis, which is a great one, there's parts of inflation that we're not even counting. And there's parts of inflation that the CPI doesn't count, right? So part of investing, as you very well know, I call it the Peter Lynch investing model. And I don't know if anybody on this call, even you guys will, but I don't know if any of your clients will, maybe some, maybe not. But Peter Lynch was a very, very famous and very successful PM at Fidelity back in the day. And he said, simply invest in what you know. And it's funny, I have a 14-year-old and I ask her all the time, what do you like? What are you doing? I watch her, I see what she's using and her friends, and she's given me a lot of ideas just by observation. And so it's the same concept, right? It's just try to invest in what you know, and just keep your eyes out for what is happening. And so there's always a lot of moving parts, and there's always a lot of creativity to investing too.
Yeah, no question about it. And we are definitely more of the barbell that you talked about in terms of our strategy right now. So I know Glenn and Dax have a number of questions, but we do have an audience question that maybe you could address first. And that is the quote, the stat that you quoted about 7.7 jobs created for every one manufacturing job. They were surprised by that because that sounded like the old days of manufacturing and not the new days of robo manufacturing and things. So can you explain that just a little bit?
Yeah, I mean, it's interesting. You can have robots and you can have process automation on the floors. And believe you me, I mean, I've spent enough time on the manufacturing floors because I own a couple of companies that are really wonderful at doing those kinds of things. But the thing that comes back, and I have the same question, by the way, this is like old school manufacturing. What does that have? But here's the thing. You need people. You still need people on the manufacturing floors. Maybe you don't need as many, but back in the day, in the heyday of manufacturing, you had, for every one job created, it was 12 that were created around it. So now you have 7.7. So it's still a big number, certainly coming down because of technology, but you can't have 100% robots. It just doesn't work that way. You still need people. You still need rationalization. You still need common sense, right? You still need to watch on the safety side of things. So I just don't think that number is going to come down materially. Does it go to 5 for every one job, 5 created around? Perhaps. And maybe we root for that, because this is actually it's very cost effective for companies. But you do need humans, you need human interactions. And that is certainly in certain industries as well, right? Maybe you could use more automation in auto builds, but maybe a little bit on the electronic side of things. But in clothing, you still need people, right? You still have people, by the way. In garments, you still have a lot of people. Maybe it's lower labor skilled people, right? But you still need them sewing, the cutting out and sewing and that sort of thing. And so it is a very good question. I just don't think we're going to go much lower. We can go a little bit lower, but you always need some sort of humans. It's almost like, people talk a lot about AI within investing. As you guys know, BlackRock has invested over $7 billion in AI into having AI help their portfolio managers invest. Well, that's great, but it's a tool. You still need common sense, right? And you still need people that are going to make decisions, and you still need perspective. And I'm not sure technology can give you all that perspective. Maybe over time, the more we feed the system and get all the information into the system, maybe over time it can happen. But I think in the meantime, we are still very much involved in the whole process of a combination of process automation and technology, as well as people.
Yay for humanity. Well, that might that might be a good segue into some questions that Dax and Glenn had around supply chains, and Dax, you in particular have been studying and thinking about this whole China issue and the rewiring of supply chains, and what does it mean that China's not exactly our best buddy right now. So maybe we can get into all that.
Yeah, well, Stephanie, I wanted to thank you first of all for acknowledging that millennials are finally carrying our economic weight in this economy as a resident millennial. But before talking about China, I wanted to ask you, you mentioned productivity and inflation. So currently we are seeing, the inputs to companies, whether that's wages or other material inputs rising. But on the flip side, we're starting to see some trends of finally productivity per worker picking up as well, which may lead to wage growth. So how does that impact, in your opinion, are we at peak margins right now within companies, or will productivity kind of outstrip inflation? And what does that mean for kind of your average American out there and their wage growth? Are we going to see some normalization in our economy versus what we've seen over the last 20 years, where the kind of the upper end has accrued a lot of benefit, while the kind of the middle class maybe hasn't?
I sure hope that the middle class gets a break. I really do. We're rooting for all consumers, right?
Mm-hmm.
But I really do believe that there is inequality right now, clearly, right? And this whole experience on COVID and all this stimulus in place, while I know that fiscal checks are helping the middle class, the markets, the equity markets, and the bond markets have helped the wealthy. Right. And so there is this disparity, which is uncomfortable. So I root for that very, very much. The whole point on, it's a good question on margins. It's a very good question because, and we're in the beginnings of earnings season right now. And I don't want to get too short term, because I'm really not. I'm very long term, just like you guys. And you don't want to get caught up in just a quarter's trend. But I think the hottest topic is going to be about margins. I have heard for the last 5 years, margins have peaked. That's really what I've heard from a lot of my peers, a lot of people that are more bearish, maybe a little more cynical. Margins can't possibly go higher. And yet every year they've gone higher, right? And so here's the reason, to your point exactly on productivity. Yes, absolutely. Companies using more technology, and for pre-COVID, even though the job market was very healthy, it still, could have been better. But I think that's the part that was always very frustrating, right? That it should be better, but no, we can hire we can put a system in place and it can replace a person. As I say, I don't think you can replace one for one, but that's what companies were doing. Here's the thing about corporate America. If they have to raise prices because of inflation, because of wages going higher, you know where they're gonna take it out on, maybe, guess what? We don't hire as many people back. Maybe we cost cut elsewhere around the firm, because we know that the CEO gets paid to underpromise and overdeliver, and it's all about earnings and operating leverage and that sort of thing. What I find interesting is margins have stayed resilient because of all the restructurings that have been put in place, especially in the last year and a half, right? I mean, there was tons of cost cutting. And as I say, I don't think that it's going to be a one-for-one return, because I think the companies are going to have to find a place to offset the higher wages. I mean, we're already hearing it from many different companies. The other thing I worry about, Dax, is if you increase prices too much, what does that do to demand? Right. So let's just take, for example, a company, a consumer staples company, not a recommendation, but Pepsi just reported an amazing quarter, but they did say that they raised prices like double digits, right? Again, another company who I'm not recommending, but just Caterpillar, they are raising prices across every single product line by double digits. So fine, that's great, because they're going to offset the higher wages and higher inflation and higher costs. But what does that do to demand overall? And that's the thing I worry about, because it gets back to the individual. If demand starts to wane and the companies aren't hiring one for one, then that will affect the consumer, right? And that will affect probably the middle class even more. So that's why it's super important to hear what companies are going to have to say in the next couple of weeks, just to say, hey, prices are going up. We know inflation is here. We know. What do you see? What are you doing about it? My hunch, just knowing and doing this for 30 years, is companies will cut costs any way they can so that they can deliver on that bottom line. And that's the unfortunate thing. So that's why we have to really pay attention. And that's maybe another worrisome point. You know, Dennis asked what I worry about, and I know that one of the clients did too, but that is certainly a worry point, because we're rooting for the consumer, we're rooting for the middle class, we're rooting for everyone to do well. You work hard, you want to make money and be happy, right? And so there's a lot of moving parts though at this point. And but your question is a good one. And I just, unfortunately, I don't see it so that companies don't really try on the other side of price increases to cut costs.
And just a reminder to reinforce Stephanie's point about not a recommendation for our audience. Just because a company is raising its prices doesn't make it a good investment. And
that's
so,
right. That's
these
right.
examples we're using here are not investment recommendations, but just stories that are happening out in the marketplace.
And
so
they're
Glenn,
public. And they're public, quite, you know, it's
yeah.
in the newspaper and that sort of thing. So, but yes, I appreciate that, Dennis. You're covering for me and for you guys too.
So Glenn, I know you had a couple of questions on related topics.
Well, Stephanie, I did want to follow up on one of the, you mentioned the Fed and concerned about kind of being late to leave the party earlier and one of the risks there. And we know, obviously, you also mentioned how massive the stimulus was. And I guess now we've doubled the Fed balance sheet in the last year or so. And we're projected to be, what, $8 to $10 trillion if we keep moving. So some people say it doesn't matter anymore. Some people are willing to buy some time and let economic growth cure all evils. When do you think, or if, will the balance sheet matter again at some point? What do you think there?
It's an impossible question. Thank you for asking it, but it's an impossible question to answer, because what I will say is, and this is, I don't want to sound cavalier, but I don't think it's any of our problems. I think it's my 14-year-old's problem, unfortunately. I do, because I think we're going to kick the can for as long as we can. I mean, we know Washington, I mean, kind of, you know, they can get a few things done here and there, but for the most part, it's reconciliation here and there and everything on both sides, you know, on both sides. It's not one or the other. It is, I think it would be very, very difficult to get something passed, and certainly in the near term and even in the medium term. And if interest rates stay low, that does buy us time, right? A little bit anyway. But higher taxes are coming. We know that. But is it really going to solve? I mean, we have a huge deficit. Is it really going to solve? No. It's going to help, but it's a Band-Aid after you've had surgery, right? So it's something that we have to watch. But I do think we're going to kick the can. And unfortunately, it's not my generation or Dax generation or any of us. It's going to be that, you know, the younger generation that's going to have to deal with this. And that's the sad part about it. But you know what? Look, we had to do what we did. We absolutely had to do. Now, my question is, okay, we had to do it. We did it. It worked. Do we actually need to do all of this more? Can't we just take a little foot off the gas? Because tapering and talking about tapering is not increasing rates, right? And do we need the $4 trillion in infrastructure bill? Could we, you know, no, we do need it, because we all know our bridges and tunnels and roads are horrific. Particularly in New Jersey, I'm just going to throw that out there. We know we need it. It's just a matter of funding it at this point in time, after we have put an enormous amount of stimulus in the system. Again, we needed it. They did a great job. But now it's time is to say, do we need emergency policy right now? And what we have right now, in my opinion, Glenn, and I'm curious as to what you think, do you really think we need this emergency policy given where we are and the progress that we've made?
No, I agree. It's a very, very tough question. I appreciate the response. And yeah, it's definitely a situation where, you know, you want to get the patient off the bed and back up and running. And it seems like we've made a lot of progress there. And I think that's obviously the big question now, is at what point do we start removing the punch bowl, whatever you want to say, tapering. And I think, you know, I think obviously the economic growth does kind of cure all evils. So I think it'll be very interesting to see the economic growth profile kind of on the other side of this. And I appreciate your comments earlier on that. And maybe that'll lead to another question, maybe a little easier, but you had talked about, obviously low bond yields, and stocks have done very, very well. They've been, valuations now are lofty, but maybe earnings are catching up. When you think about that typical investor, maybe 60% stocks, 40% bonds, what do they do going forward? Is that still an appropriate allocation? Or, like Dennis mentioned, we're actually considering other alternatives, maybe to bonds, for example. But what do you think in that regard?
Well, it's a great question, and I get that question a lot. And two Octobers ago, this is weird, right? 2 Octobers ago, there was an article in Barron's that actually had the cover is 60-40 dead. And I thought, oh, wow, okay. So, and at the time I was starting to get a lot of questions, not two Octobers, last October, sorry about that. It was starting to get a lot of questions from advisors, but also colleagues, and we were talking about it and scratching our heads. This, by the way, was when yields were a little higher than where they are today. So I got that question a lot, and I read the article, and I thought it was spot on. It's, and you guys, and I would love your opinion, and the ideas that you're giving your clients, because I think it's absolutely dead for now. It's not going to be dead forever, because I just don't think we're going to stay at a 1.3 10-year forever. But are we going to go to back to 5%? Unless we have huge inflation and maybe stagflation, which I don't see. But if we do, that's what would get you a 5%, 3, 4, 5% 10-year. We're nowhere close to that. So if we stay even at 2 or even at 3, it's hard to find places for yield and total return. And so I kind of feel like you still, depending on the age of your clients and that sort of thing, and their strategy and their philosophy and all of that, I have no problem with a 60% equity allocation over time, especially if you're diversified. I was very, very fortunate. My father is in the business, and I was very, very fortunate when I was right out of college. My father said, you know what, just take $10 every month and dollar cost average it in an index fund. I was very fortunate. I said, Dad, I don't even have $10. He goes, I don't care. Just go find the $10, and that's what you do. And honestly, so 30 years later, we still invest that way in terms of not just index. That's just an example, but it's the compounding impact, and that's what's very attractive in terms of an equity investment and dollar cost average, because you're never going to time it and that sort of thing. But on the 40%, I think it's very hard to put 40% of your allocation into fixed income, particularly after this huge rally. I think you could do 20%, certainly. I mean, I view bonds as, I don't want to create alpha with the bond portfolio. I want to sleep at night. I want to hit it right down the fairway, and I want to just really plain Jane vanilla kind of investments on the bond side. And though I just don't think it's a great investment, it's something that I think you can kind of sleep at night with. And then that other 20%, you got to be creative, as Dennis alluded to. Is it preferreds? Is it REITs? Is it alternatives? Those are longer. I mean, alternatives are long duration kind of an asset allocation, but I get a lot of questions on alternatives there, but that should help too. I also would suggest within the equity portfolio to try to find stocks that act like bonds, which are simply to say stocks that have high yields. Now, you don't want to have high yields, super high yields. You want to have growing yields and growing dividends, because high yields, more risk, right? The higher the yield, the more there's questions about, can they fund that? So, but there are plenty of places in the market today that offer 2.5%, 3% dividend yields. That's not bad, right? I can't believe I'm saying this, but the banks, all the capital that they have been accumulating over the last several years has been just incredible. And so now they're starting to return it to shareholders. We're going to even have, of all things, banks have almost a 3% yield. So, but there are all kinds of companies. Consumer staples companies, I think, are certainly interesting. I think some of the telecom companies are very, very interesting, because they do offer a secured dividend and a growing dividend. And I think that's a kind of a wise strategy. But in terms of where else do you go on a bond for bond alternative, I think the biggest place to start to do some work on is alternatives. Do you guys get a lot of questions on alternatives?
We do. And I think
Yeah.
that ballast point you made earlier, we're always, when we're talking about underweighting fixed incomes, we agree. We've been trying to find other sources of income and other sources of return. And whether it's illiquidity, if we do go into some of these alternative or other asset classes, or just making sure we understand the correlation with stocks if other asset classes are chosen. And so it's really just having those conversations, I think, with clients. I'll be curious, Dennis, Dax, may have other thoughts, but really just trying to make sure they go in eyes wide open, and we're just trying to get them the best risk-adjusted return at the bottom line.
Mm-hmm. It's very, very difficult. It's a challenging time, and I thank goodness that your clients have you guys to actually help navigate them, and because we're all trying to just at the end of the day, we're trying to preserve capital, grow capital, and it's a bit challenging because, to your point, the equity markets are definitely fully valued for certain. So you got to be very, very careful in terms of what you're doing.
Yeah. Well, yeah, and we've had a pretty good exposure to the dividend growing stocks. It's an area that we've liked a lot, and the so-called dividend aristocrats that have a long history of growing their dividends. But as Glenn mentioned, we haven't wanted to overplay that theme, because if you had some nasty downturn that came out of the blue, those things aren't going to behave as well as some of the other bond alternatives or bonds themselves. So yeah, so it's definitely an interesting balancing act. And to your point, when will this normalize? And after the Great Recession of 08-09, folks were saying, well, maybe it'll normalize in 10 years. Well, here we are, and we had the pandemic, and then that forced interest rates down. Is it another 10 years? Boy, good question.
That's a long time. And I know we're all long term, right? And so but we're all trying to think a little bit more long term. And as I say, preserve capital, grow capital, and just protect what we've all worked so hard for. So but these are really, really challenging times. And I kind of laugh a little bit when the commentators on TV, and I could kind of laugh at them because they're friends, but they start off with a negative they start off with, oh my goodness, there's so much to worry about. But oh, by the way, the market's at a new high, record high. It's like, well, there's a lot going on underneath the surface. And sometimes I just simply say, turn the TV off and just kind of focus on fundamentals and what you guys do well.
Yeah. Well, and I don't know that we'll have time to get to the question of in our audience about what's Jim Cramer like to work with.
I'm happy to. Look, by the way, I still talk to him. In fact, we were emailing this morning about retail sales and the numbers today. We're both junkies in terms of the markets, and we both used to compete. Is a nice way of saying it. Who could get on the treadmill first at 3:30 in the morning? Was it 3:30 or 3:35? And then work out and go through all the information. He's brilliant, absolutely brilliant. He went to law school. He went to Harvard. He went to Harvard Law. And I think he's much smarter than that he gets credit for. I think he is, a lot of what the shows are, I wouldn't say it's an act because he's very genuine, but he does have, he has a very dry sense of humor. And I think he very much enjoys trying to teach people about markets and ideas, but at the same time, making it fun and keeping it simple. And I will say this, I learned two things from Mr. Cramer. Because I had been in the business 16 years before I joined him, but I was on the sell side and I wanted to learn how to really run money and be a portfolio manager. Number one, keep it simple. And whenever you're trying to explain anything, not get so, that's why I use the word wonky. Try not to get too wonky. You could get a little bit because obviously it's what we do and we're passionate about it. But the second thing is he was amazing at just timing things in terms of portfolio stocks and positioning and when to buy something, when to add to something, when to trim. And he's always a little emotional, I will tell you that. And he's more of a momentum person and I'm more of a GARP kind of growth at a reasonable price person. So we butt heads a lot, but he actually respects people that butts heads with him because not many people do. People are afraid of him, but he is salt of the earth. And I will tell you this one story. And I told him I'd tell everybody this story because it is such a special story. So after I decided I was going to join him, I had just had my daughter at the time, and she was a couple months old. And I have always wanted to work, be a career person and that sort of thing. Well, a day before I was supposed to join him, I said, I can't leave my daughter every single day. I just can't do it. How am I going to do this? And I had this emotional situation happen. So I call him and I said, I can't work for you. I'm sorry. And he goes, what? And I said, no, I can't work for you. He goes, why? And I said, because I can't leave my daughter. I just can't, this is not going to work. I'm going to be commuting all the time. I'm never going to see her. He said, okay, so what will it take? I said, what do you mean, what will it take? He goes, what will it take for you to come work for me? I said, I want to work from home 2 days a week. He goes, done. He's like, you want 3? Take 3. He's like, I don't really care. And this might seem very commonplace now, but I promise you, years ago, it was not. And he was one of the very, very first that actually was so super supportive. He's a family guy. He doesn't seem like it, but he's a family guy. But let me just tell you, even though I worked 3 days at home, I worked my tail off. I worked even harder being at home than I did when I would be at the office. But he's a genuine person. He's a smart person. He knows markets super well. And it was an honor to be able to learn from him.
Yeah, very nice. Dax, you get the last question.
Oh, well, we're coming up on the top of the hour, so I don't want to make it too complicated. But do you see, obviously, with the previous administration, there was an escalating tension with China, and then the pandemic hit, and we had some learnings with supply chains.
Yeah.
Do you see a trend towards resiliency within our supply chain and bringing that back over? And how do you see, over the long term, U.S.-China relations evolving? Are we going to go counter trend versus the last 20 years in globalization, or are we going to make up, so to speak?
Yeah, I just don't see that the relations are anywhere near kind of getting calmer. If anything, it seems to be escalating. Look, before COVID, the US introduced very serious protection aimed at China. The US was taxing half of imports from China at a 25% rate. That's a big number. And what's interesting about that, Dax, is just kind of thinking about the derivative of what does that even mean? Well, as a result of this, actually, it helped other developing countries take on that slack. So garments and footwear and electronics all shifted to Vietnam and Indonesia and Mexico. And so you had this massive change. Even that's before COVID. And it's only continued at this point. If you add on that China has higher wages than these other countries that I mentioned, that even was more fuel and more of a tailwind to have this whole process shift. So China exports to the US fell dramatically, as you would imagine. But to these other countries, it actually rose quite substantially. In fact, the Asia Pac is number 1 as China's partner. Europe is number 2, and we're now number 3. And so I only see that continuing. What's interesting is China is now the middleman, right? Making some of the machinery and the components and then sending it over to the Asia Pacific countries for final assembly. So they're working more closely together, and we are much more separate. And I only see supply chains actually changing around the world and continuing to move out of China. And companies were much too concentrated, and they felt it when Trump put in those tariffs. So they've learned the hard way. That's not a bad thing. Having a diversification and diversified supply chain model, I think, is very smart. And so we can do round 2 if you want to talk about this topic. I'm sorry we didn't get around to it, but I know we're up on time, so I'm going to defer to you guys on that.
Well, thanks, Stephanie. And I think we need round 2 on actually quite a few topics to dig even deeper. Thank you again for joining us today. Great conversation, fascinating discussion, and a lot of things to keep an eye on in the future. Thank you also, Dax and Glenn, for participating in this. And I'll remind our audience that we have been recorded. We will be on the YouTube channel, our YouTube channel shortly, and you can pick it up there. And again, Stephanie, thank you very much.
Thank you, guys. Best of luck. Stay safe.